I'm Aditya Mohan and I work in the GDA space at Forest Mazars. And with me today is Vivek sir, who has over 20 years of experience in finance and consulting. He's worked on appraisal and funding of over 250 plus projects, worked on many transport and logistics infrastructure, including toll roads, logistic parks, and port terminals. He's worked on financial modeling, appraisal, including preparations of DPR, TEV, valuations, and bid advisory. So today's topic, it is incredibly relevant. It's not just for finance professionals, but also for those involved in project planning, logistics management, government policy, or infrastructure investment. Now, why? Because in capital intensive sectors like this, decision worth crores, sometimes thousands of crores are being made, and these are based on these models. So imagine you're planning a logistics park near a port. So you would need land, warehousing facilities, you would need cold storage, maybe even a rail siding. But before anything starts, before even 1 rupee is spent, everyone from the investors to the government, they want to know if this is viable. So that's where a financial model comes in. It helps you simulate the project on a spreadsheet before it happens in real life. So this session will walk you through how that simulation works from inputs to outputs, and by the end, you'll know what goes into a good model, what mistakes to avoid, and how to start thinking like a modeler. Now, this being a short introductory course, we will not be going into every detail, but cover the overview of financial modeling, the essential aspects. It will serve as a high level roadmap with key signages to help you navigate your individual exercise of creating or reviewing a financial model. So, here's what we'll cover in this webinar. We'll begin with the basics, what financial modeling is and why it matters. We'll talk about how the model is structured, CapEx, OpEx, revenue flows, and linkages. Then we'll go into key inputs. What are your numbers and assumptions that go into your model? Then we'll dive into the outputs and key financial metrics, what they mean and why they matter. After that, I'll walk you through the steps to actually building a model. Then we'll look at the common mistakes people make and best practices. Finally, we'll touch upon advanced ideas like sensitivity analysis, PPP funding, and more. I'd encourage you to jot down your questions and then we can take them at the end. So, let's start with a simple definition. What is financial modeling? So, in the simplest of terms, it is a process of building a tool, usually in Excel, that projects the future financial performance of a project or business. So, now you might ask, why is this important in transport, logistics, and infrastructure? So, here's the thing, these sectors deal with high upfront investments, long gestation periods, complex financing structures, and long payback cycles. So, we're talking about highways, metro systems, freight corridors, warehousing hubs. So, these aren't built overnight, and the return on investments may not happen for the next 5 to 10 years or even more. So, a model helps you by providing an analytical framework for decision making by quantifying the understanding of the project model and it's dynamic for objective decision making. So, how does it do it? It does this by evaluating things like how do revenues and costs behave over time? What's the break even point? Can the project service its debt? What are the expected returns to investors? What is the payback period? What is the high sensitivity factors and what are their impacts? And more importantly, it's not just about building it for yourself, but a model must be understandable to the stakeholders as well. Stakeholders like lenders, investors, public authorities, and internal decision makers.
The key point to understand here is this that a model has structured projections. And what do we mean by structure? That one part is connected to another. There will be multiple connections, ideally few, but there will be quite a few connections in every model. Second, in the structure, there should be a clear flow from input to output, and there will be common elements which will tie up the model together, like your timelines, currency, and other units. A pro tip before we get into the details, whenever you're looking at a model, you need to understand the business model which it is modeling. And then think about your design options. That way, your model will be of higher utility. So remember, a model is a tool which is used for decision making. Keep this thought in mind whenever you are building a model. In this course today, we'll be talking about a lot of these aspects. So let's get into the details. Aditya, over to you.
Yeah, so now let's talk about the structure of a financial model, what it looks like, and how all the parts connect. So think of a financial model as a machine that is based on a certain design, uh, it and made of various parts. It processes the raw materials and it gives you an output. So similarly, a model is based on a certain logical structure. It takes in inputs and gives you outputs. Like a machine, when the inputs vary and there is some issue with the machine parts, the outputs also tend to vary. Because of that, you would have heard of terms like garbage in, garbage out, black box in respect of the models. Now we will discuss what are the attributes of a good model and the common mistakes in latter part of today's discussion. Some of the major challenges and how to deal with them will also become clear then. Now, yeah, so the first point is the inputs. So inputs are the measures of independent project variables that you would feed into the model. Now these variables or inputs include assumptions about project costs, revenue drivers, financing terms, timelines, tax rates, and inflation and escalation rates and macroeconomic variables. Now these inputs must be comprehensive and realistic as they determine the model's utility. Now, once your inputs are in place, the project should be calculating project key output variables like outflows and inflows. So, over the period in consideration based on business logic rules and inputs provided. So, typically in an infrastructure model, many different projections are to be calculated. These may be considered as the subparts or modules of a financial model. So you can look at capital expenditure, financing schedule, capex financing schedule, debt and interest schedule post capex, depreciation schedule, income tax payable. So all of these can be considered as the modules of the model. Now, these projections are spread across project life cycle like construction, ramp up, stabilization, and maturity. They help capture seasonal trends seasonal trends, inflation impacts, and growth assumptions. So, for example, if you're making a financial model for a road, toll revenue projections can be built on an assumption of 6% annual traffic growth and periodic tariff hikes. For a logistics park, you can look at the projection, you can consider projections to be linked to the phase leasing, and you can assume 30% occupancy in, let's say, year one, 60% in year two, and up to 90% in year four, with lease escalations every 3 years. Then, after all of this, all the projections flow into the core financial statements where they are consolidated into the following statements. The first statement would be profit and loss, which you make to assess profitability. Then you make cash flow to assess liquidity and funding requirements, and then balance sheet to ensure that the capital structure is balanced and viable. Now, these three statements are standard statements for reporting of financial numbers. You will see them in annual reports of all the companies. Finally, we will create summary tables and test different scenarios like best case, base case, and worst case. So this helps stakeholders understand how the project may behave under stress and what risk exists. In short, these four building blocks like inputs, projections, financials, and scenarios, they allow us to simulate reality on a spreadsheet and guide real-world investment decisions.
So
Now,
wait, I think just a point here. So when we are talking about model, remember we talked about a model being a structured projection, right? Now, one way of thinking of that structure is that it's in layers, right? So your input is your first layer. Over and above your input comes in the projections. Then you have the financial statements. Then you have the summary, and there's a linkage between these layers. So when preparing a model, it's a good idea to visualize how your model looks. It helps you in framing a simple design as well as in understanding the model, and more importantly, communicating how the model is structured. In my experience of financial modeling for a large number of projects, what typically happens is that the model tends to get quite complex, and understanding a model is difficult. So often, when you look back at your own model 6 months down the line, it takes you a while to understand what thoughts have gone into it. So visualizing that model, understanding the basic structure is important. Often we think about financial modeling just as a simple Excel exercise. It's more than that. Excel is a tool. Your thought, your process, your understanding is what makes a model good or bad, useful or not useful. Yes.
Okay.
The next slide.
Yeah. So now let's talk about the inputs in some detail. I like to think of these as the ingredients of a recipe. So if your inputs are off, even the best drilled model won't help you.
So what are these inputs we are talking about? These inputs are basically about some project variables, right? And as we define these inputs, these are estimated measures of independent project variables, right? So which would mean what? One, these are project variables. What we mean by project variables? Anything which can have an impact on the outcome and performance of the project, right? So everything which is material to the project model, to the business model in the real world, should be considered as a variable. And that's one. Second, it's a measure. So there is a quantification which has to be done. Everything you bring into the model is quantified in some manner. Mostly, it's a number, it's a measure. It can be a simple measurement of the size in some way or the other. It could, in certain cases, also be ranking. Okay, so remember that it's just not a ordinal scale. Sometimes it can be a nominal scale of measurement as well. Third, and a very important point to understand is that these inputs are estimates of how reality would fold in near future. So as a modeler, try to keep this in mind that your numbers are not sacrosanct. Your numbers could have a high probability of occurrence. And when do they have a high probability of occurrence? When there is a strong logical basis linked to the reality of the model and the external environment. So these aspects about what inputs could be is important, because when you're looking at modeling for different projects, a lot of time what varies between one model and the other is the kind and the number of inputs you have. So it's important when we're talking about inputs, one, that they need to be realistic. Second, they need to be comprehensive. Realistic, which means high probability of occurrence. Comprehensive means all material factors, all material independent project variables which can have an impact on the project model are considered in the financial model. Yes, Aditya.
Right. So now there are four broad categories of inputs. So the first one we'll discuss is capital expenditure or CapEx. So this refers to all the upfront investments required to get a transport, logistics, or infrastructure project off the ground. So basically all the physical and digital assets that are needed to make the project operational. So this can include tangible items as well as intangible items. So tangible items like land acquisition, civil construction, equipment, vehicles, IT system, and intangible items like design and engineering, market studies, administrative expenses. So now, one thing to note is that CapEx is usually front-loaded, meaning most of it is incurred in the initial stages, and it's often the largest single cost component in your financial model. So let's look at two examples. So in a case of a logistics park, CapEx may cover the land development, development of warehousing structures, internal roads, cold storage units, uh, solar power installations, and surveillance infrastructure like CCTV cameras. In a case of toll road project, CapEx includes the earthwork, highway paving, construction of overpasses and underpasses, bridges, service roads, and toll plazas. Now, it's a massive civil effort that defines the physical backbone of the project. Now, what's also important to note is that CapEx numbers are not pulled from thin air. They're derived from detailed technical plans, cost estimates, and development or concession agreements. So these inputs form the foundation of your cost assumptions, and any variation in them directly affects project viability. So whether you're modeling a logistics hub or a highway corridor, your CapEx assumption must be realistic, well documented, and in sync with engineering and legal inputs. Additional things to notice, sometimes your CapEx may be phase-wise. So in such cases, separate assumption sets are required. And post-operation upgradations may also be required. So in that case, that also needs to be considered. Next, we'll be talking about financing. So, uh, this we'll look at how the project is financed. So we can look at debt and equity mix, terms of financing loan like interest rates and tenure, and other terms of financing. Other factors may also come into play here, like for example, if you're considering foreign currency loans. So, in this case, forex rates and hedging costs will also be an input. If subsidy or funding arrangements like viability gap funding is applicable, then that also needs to come into play. If a bank loan agreement may also stipulate certain conditions on upfront equity. So in that case, that also needs to be included. And sometimes there may be two types of loans, like one would be subordinated to the other. So that also needs to be captured. Now, this is where it gets interesting and industry specific. So based on the business model, revenue assumptions need to be added. Now, these can basically be of two types, volume or traffic flow, or and the revenue rates or the charges to customer. So these may be consolidated variables, that is one for all segments or segment-wise variables. Growth rates on initial assumptions will also need to be considered here. Growth rates may not be same across the year, and initial volumes and growth rates are estimated on the basis of market assessment. Uh, Now, for revenue rates, the growth may be linked to some government policy or maybe market determined. For example, in a toll road, volume assumptions will have to be broken into types of vehicles, arrived at a basis of a market study. Revenue rates or toll rates are determined on the basis of the government's toll policy. Now, in container terminals, volumes will be counted in terms of TEUs. So this may have to be segmented basis on the type of the cargo. So for example, dry or liquid or general hazardous, reefer, non-reefer. Then volumes at different points of service may also differ. So if applicable, that also needs to be considered. Revenue charges may be on the basis of the type of cargo and type of services. Now, we'll talk about operating expenditure. Now, these are your recurring expenses, monthly or annual. So this could be salaries, utilities, fuel, maintenance, securities. Now, how to build in initial OpEx assumptions? You take in consideration the technical and business plan. You consider the volumes of business. You look at the bottom of calculate. You do bottom-up calculations or benchmark-based calculations. Now, OpEx assumptions can have the following components like volume of consumption, cost per item, cost benchmarks, inflation factors, and these may vary with cost items. So not considering proper inflation factor is also a common mistake. So one must be careful about that. Now, finally, we'll talk about marketing costs. Now, it is often assumed that marketing costs will not be incurred, which may be true for monopolistic or oligopolistic business scenarios, but often in transport and logistic infrastructure businesses, that is not the case, and you have to face competition. So, expense on B2B marketing may also be required, and that also needs to be considered. So overall, OpEx is not just a budget line, it's a dynamic component that reflects the scale, maturity, and strategy of your infrastructure assets. Now, it is a good practice to keep all the assumptions in a single sheet, normally called the assumption sheet, with input cells clearly marked out so that they can be read or reviewed easily. So now let's pause for a moment and reinforce what we've studied already. So we have a question for you. So which of the following is a typical revenue assumption in a transport infrastructure model? You'll have around 15 to 30 seconds to answer. These are your options. You can put your answers in the chat box. Yeah, so the correct answer is tariff per ton. So this is one of the fundamental revenue drivers, especially in port, rail, and logistics model. It's important to remember that assumptions related to tariff, volumes, and throughput are central to any transport infrastructure model. Yes.
Yeah. So let's talk about the projections now. Inputs is the first layer. Projection is the first output layer. So the way to, I mean, what are projections basically? Like if you could ask, define projections in a certain way. Projections could be defined as, these are calculated project-wise estimates based on what? Based on one, the inputs or the assumptions you have made about the business and the business model or the business plan. How do projections typically look like? The projections would be, like a 2x2 table. So, Aditya, if you would just show a sample here.
Yeah.
Yeah. So, I mean, your projection table, any projection table would broadly look like this, right? So, where you have rows here on the row side, and you have items, and then you would have a summarization. It would differ from one table to another, but broadly the structure is like that. And the data basically you fill in is the calculated value. So using the inputs and the business logic, you calculate these values for a specific period. Okay, can we go back? Yes. Okay. So within a financial model, there are multiple types of projections, right? And these need to be built. Let's talk about these as in some detail. So the first, and one could consider each of these as modules. What do we mean by module? If you're familiar with designing aspects, modules or sub-assemblies, as you would call in, say, a manufacturing terminology, are parts which are in a certain sense complete in their own, and you can plug into the other part. Why do we have modules in financial modeling? You set aside a certain set of calculations in one place, and then you take the output from there into another place. This way you have a better control when reviewing the model. Also, you know whether changes have occurred or not occurred. So a modular approach to modeling is an important thing, and the modules typically you will have would be these. So starting with the capex module, because we're talking about infrastructure project, and all infrastructure projects, capex is where you typically start with, because capex is front loaded. Now within capex schedule, there is this the capex schedule or the capex table or the capex projections, what do you have? You basically have the outflows through the construction period. Now, in any infrastructure model, whether it's a transport logistics infrastructure or a power infrastructure or any other infrastructure, typically you will have a construction period, and post that you'll have a operation period, right? And the date which defines the transition from construction to operation is typically called as a COD, commercial operation date, right? So in the capex schedule, you'll have outflows through the construction period towards what? Towards the capital expenditure items which Aditya talked about earlier, physical assets, design, engineering, administration expenses, and so on. The table will look like the table we had shown just some time back, right? Besides the capex, there is another item which gets into it, right? Remember, when you are spending on capex in large infrastructure projects, you would have also taken a loan. You would also have taken some kind of a financing arrangement, and there would be a cost associated with it. There could be an interest cost, which is typically during the construction period, it's called as the interest during construction, IDC, a term you will be familiar with if you're in, if you have been involved in project finance or project planning. And there could be other costs, for instance, like bank guarantee costs, etc. So these will have to be considered. These are capitalized and taken to the gross fixed asset category. The sum of the capex and the financing cost, maybe with something else like a contingency, put together add up to the total project cost. Another typical term you will come across in infrastructure projects. Okay? Remember, so a capex schedule is for for the capital expenditure. But sometimes what happens is capital expenditure, all capital expenditure may not be in sync. There would be phases to it. So you will have phase 1, phase 2, phase 3, and so on, and which may be spread over time. So phase 1 gets constructed first, and then you'll have a operation period. And during that period, you'll have, say, a phase 2. Right? So if there are situations like these, your capex schedule need to be created phase-wise, right? So that's one factor. Another important factor to consider while doing projections is inflation. Sometimes we do not consider that, but remember, in a lot of these projects, you will have construction period spanning over 2 years, 3 years, sometimes more as well. And if it's in a phase-wise thing, you could possibly have, say, a 3 years, 5 years kind of a construction period, a construction period which may run parallel with operation period of an earlier phase. In such situations, inflation become an important factor. Remember, when you have developed your DPR or technical plan, the costs would have been taken as on that peak in that year. When you're actually doing the construction, inflation, those costs would likely have increased. Because we are largely living in an inflationary environment, those costs would have likely increased, and you would have to consider inflation there. Right? Coming to the next module, which is the financing schedule. Right? Within financing schedule, you have one which is called as a drawdown list. Now, this is related to the capex. What do you draw down? You draw down on the equity and the debt. Right? In what proportion? In proportion to the capital expenditure. So your drawdown schedule should match with the capex schedule. Any financing term, like something which Aditya mentioned earlier, like upfront equity, those need to be factored in. Subsidy, grants, subordinated debt, preferential capital, all these would form part of a drawdown schedule. Because capital comes at a cost, you'll also have to calculate the interest schedule, right, and the repayment schedule for them. So typically, repayment would happen after the COD, the commercial operation date, when the operation has started. There could be a moratorium period. Typically, there is a moratorium period when principal is not to be repaid. There's no principal installments then, but interest is payable. Remember, the day you take a loan from the bank, the day the drawdown happens, your interest meter starts. So you'll have to account for those interests in your financial model. Other financing costs also would have to be considered. This is what comes in within the interest and the debt repayment schedule. Right? If the capex is in phases, then those have to be considered accordingly. Within the financing schedule, there could be another financing arrangement as well, which is called as a working capital financing. Typically, this would come after the project has started. How you finance working capital may differ. It could be a revolving loan like a cash credit, or it could be a short-term financing, right? So accordingly, you will have your drawdown schedule, you will have your interest and repayment schedules. Coming to revenues. Revenue projections. What is revenue? Basically, in a transport logistics setup, it's volume into tariff, right? So you will have revenue projections where you will have one row which will say volumes, the second row which will say volume growth in volumes, third row which will be growth in which will be the revenue rates, which is like your rate per kilometer per, which could typically be say in rupees per ton or rupees per ton kilometer, or things of that sort. And there would be a fourth row which would be growth rate in the revenue rates. And when you multiply the volume into the revenue rate, you get the revenue. If there are multiple segments, right, then there would be different revenue projections. Why? Because the dynamics, the growth rates, the initial rates, the volume growth rate would differ segment wise. And if you take it in aggregate or say an average, you will typically be off the mark. Okay, so that's how it would be. For instance, say how it would happen, say in a logistics park. In a logistics park, typically, in the current kind of logistics park, which typically are built, over 50 acres, 100 acres, and so on, you will have different segments. So you will have segments for say dry warehousing, chemical storage, fertilizer storage, food storage, silos, etc., etc. The rates would be different from all of them, and the volumes, the market dynamics would be different for all of them. So you would calculate revenue projections for each segment. You'll say revenue for dry warehouse, revenue for cold warehouse, revenue projection for say your silos, revenue projection for your stockyard, for your open stockyards, etc., etc. So that's how you would calculate the revenue projection. Remember the factors which come into play here: your volume, volume growth rate, revenue growth rate, and the period. Okay. Going to the next point, which is your OPEX estimate. OPEX is the expenditure you incur to earn those revenues. So it's incurred on a on a regular basis, as we talked about in the last slide. Now, the table, in terms of your structure, the OPEX table would not look very different from say your revenue projections, right? But the items would be different. These items would be, if you have to classify them, there would be two categories, basically, like your direct costs and your indirect costs. Direct costs are material, men, etc., which are directly engaged in the operations. And then indirect costs would be, your admin, marketing, repairs and maintenance, etc., etc., which would be indirect costs. Now, why are these important? Because the way you're projecting them, the business logic in your projections would be different from them. Direct costs would have more likely a direct correlation. So as your volume increases, your direct costs would increase, right? Whereas the indirect costs would have, say, a disproportionate, an underproportionate relationship with the volume. So it will not increase at the same rate as the volumes would increase. So when you are doing your OPEX projections, don't do similar logic, apply similar logic for all your revenue OPEX estimates. Understand how is it related to the volumes, when is it incurred, or when is it not. There was this one point being talked about, for instance, in marketing costs, right? Marketing costs typically are important in the initial stages. Your IT cost may be important in the initial stages when your basic cost is incurred, and then you have a lower subscription cost followed by maybe, say a periodic upgradation every 5 years and so on and so forth. So in those periods, maybe, there might be a higher expense. Then you come to depreciation schedule. Depreciation schedule is what basically you depreciate your capital assets. Those need to be calculated. Remember the thing here, the depreciation rates are not same for all assets. For land, there is zero depreciation. For building, there are certain depreciations. For plant and machinery, there could be certain depreciations. For IT systems, there could be different depreciations. Also, depreciation rates differ by, there is a Companies Act rate, and there is a tax rate, and there is an economic life factor which needs to be considered. So there a thought needs to be given, and that needs to also to be clarified when you are calculating your depreciation. A linked aspect, but not totally the same, is a tax schedule. Income tax, which is the direct tax, and the indirect tax. The direct tax is on the profits. Remember, there are schemes which are available like your ATIA, and there might be other exemptions which may be available for infrastructure projects. Those need to be accounted for. That's one. Also, you may sometimes have, accumulation of losses and adjustment of losses going forward. So those need to be considered when you're calculating the tax due. There is also case of GST inputs, so indirect tax, where you have inputs available which you may utilize going forward. So all these need to be considered. So your project, from your basic set of inputs, your financial model starts getting bigger and more structured. Different modules come into existence, right? So this is projections is where you're calculating, doing the forward estimates for items, for segments, and so on and so forth. Yeah. Aditya, what do you?
Yeah.
Yeah, just a point
So
here. Aditya, just a point here. So an important point to understand here is how much level of detailing you would do, right? You can get into very minute details, or you could do an aggregate at the end, okay, at a very broad level. For instance, in toll road, you'll say so many cars, this is a rate, this is an inflation factor, this will be the number, right? I mean, there are sometimes, a lot of these infrastructure projects, first initial assessment could be made on a simple sheet of paper as well. So those are at aggregate levels. In the financial model, it's important to have some level of detail. What is the level of detail? A principle which has served me well is that, if the scope asks you for a certain level of detailing, you go one level more, one level of detail upwards, right? So if the numbers in crores, you get into lakhs. If the numbers are, say, talking about, say, top 5, you go into, say, top 10, and so on and so forth. So that you, if required, if during your projections you come to an understanding that, there are other factors which are more important, it's not neglected upfront, and to do it later sometimes becomes a problem. That's one. Second is the length of projection, right? How long? 5 years, 10 years, 15 years, 30 years, 50 years, right? Now, estimates over 5 years, typically it's very difficult to, kind of uh, have a reasonable assessment of what could happen after 5 years. Even policies are not clear beyond that. So one good way of looking at how long your projections should be is to look at the payback period. So, for instance, what payback, debt or equity? Typically, one should consider equity. So, if equity payback, say, for instance, comes to, say, 3 years, have a 5-year period of projections. If your equity payback is 10 years, have a 15 years projection, and so on and so forth. In PPP projects, where your bank may typically ask for the whole length of projection. So, if, say, for instance, you have a 20-year concession period or a 30-year concession period, you may require to project for those many years. Yes, Aditya.
yeah. So now let's look over the 4 key outputs of a financial model. Now these are the consolidations of the projections in a standard reporting formats. So the first one we'll discuss is the profit and loss statement. So this statement, it gives you a full picture of the scale of operations, its cost and profitability. It includes projected revenues, operating expenses, and EBITDA. So EBITDA is earning before interest, tax, depreciation, and amortization. It also has depreciation, interest, and net profits over the entire life of the project. So it helps you answer the question, is this project generating enough income over time? The next statement is the cash flow statement. So this captures the actual inflow and outflow of cash. This includes operating cash flows, investment outflows, and financing activities. Now, this is especially important for evaluating the liquidity and free cash flow to the firm. Now, balance sheet, this shows the financial position of the project and at the end of the period. Now, this includes listing down assets, liabilities, and equities. It helps ensure that the capital is accounted for and funding matches asset buildup. Then finally, you calculate the return. So this output includes key metrics like internal rate of return, net present value, payback period, and financial ratios like DSCR, ROCE, and ROE. Now, these are essential to evaluate how attractive the project is to both equity and debt stakeholders.
Yeah. When doing your financial modeling, it's important that your outputs, these outputs should be output only, which means there's no input in here. You don't allow inputs here. And remember, in terms of how we talked about the layers, this is your third layer, right? You have inputs, projections, and consolidated outputs. Okay, so that's one thing. The other thing, where your financial statements, these consolidation would also help you, since it's the first time you're looking at the project in a consolidated way. It's important to run some checks. One check you typically run is a balance sheet, asset equal to liability, match ho raha hai, nahi ho raha. That's the first thing you look at. Second, is there in some year a net negative cash balance? You can't have a net negative cash balance, right? You can't operate when your bank balance is negative. So that those would not happen. Your capex is being fully funded, right? You can't have, I'm spending 100 crores, but I've funded only for 90 crores. Those situations cannot be. So that's one level of check you can look at, right? The other is to look at sanity checks. Typically when say, apply your balance sheet, P&L, cash flow reading skills. Does it look reasonably fine or not, right? What happens is that when you're putting inputs, because you're single numbers and you don't have a time perspective in mind, often you put a number and say, okay, I mean, like 3%, how does it matter? But 3% over 20 years becomes, when compounded, becomes a very big number. So and you will not realize it unless you look at your financial statement and say, okay, why is my revenue suddenly going up? I started with, say, an EBITDA margin of 20% going to 30%, and you have a 50% project EBITDA margin. Now, no business in the current scenario of a similar nature, right? Of a similar nature gives you that much of margin. So why is my projection showing that much margin? So it would mean that you look back and check whether your rationale, your understanding of the business logic, and your assumptions are correct or not. Similar for other cases, in terms of how your cash flows are, in terms of how your returns are. When you are doing, say IRR projections, remember, IRR is a very interesting tool, and we'll talk about it in the next slide. Your IRR, if you're taking for 3 years, 5 years, 10 years, 15 years, will will show a very different characteristic. It's not a linear calculation. So these are factors, when you're looking at a balance sheet, a P&L, spend some time looking at it and understanding, okay, how is my projections going forward? How is my margins going forward? How is my OPEX going up? Which is the greatest contributor? Is the contribution changing over a period? Now, these are aspects which you learn over a period of time, and but it's a good idea to keep them in the back of your head, so that when you're evaluating models, when you're preparing models, you are more realistic than somebody who's not as well prepared. Yes, Aditya, next slide, please.
So now, once your model is structured, you need to extract meaning from it. And that's where your financial metrics come in. Financial metrics may be classified in the following categories, which are profitability and operational metrics, return metrics, debt serviceability metric, and valuation metric. So we'll start by looking at profitability and operational metrics first. So the first one we'll discuss is EBITDA margin. As I mentioned before, EBITDA is earnings before interest, tax, depreciation, amortization. So for a viable project model, EBITDA margin should be positive and comparable with the industry peers. So initially your EBITDA margin may be low and over time it might increase to a stabilized level. But if in comparison with industry peers, if the margins are significantly lower or higher, there should be a reasonable business logic for that. Next is your net profit margin. Now, similar to your EBITDA margin, but it takes into account interest, depreciation, and other incomes or expenses. So, initial net profit may be negative for many projects, though at cash profit level, it may be positive due to the adding back of large depreciation amount. So, if your net profit margin is consistently negative for medium term, it may imply that the project viability or financial leverage may not be sustainable. Now we come to operational metrics. So these are the metrics which can indicate operational efficiency. These metrics they vary by industry, and typically these metrics link a P&L item with a balance sheet item. So while when reviewing the model and estimates, these could provide insights into the strengths and weaknesses of business estimates. If there's any odd number which is out of sync with the peers, that will need to be justified, and this could serve as a good test to how reasonable a financial model is. Now, we will look at the return metrics. So, the first one we'll talk about is the internal rate of return. Now, IRR is a discount rate at which the net present value of your project becomes zero. It tells you the project's internal profitability. If your IRR is greater than the cost of capital, the project is financially viable and subject to the fact that input assumptions and calculations are realistic. Then we'll talk about net present value. So net present value measures how much value a project creates today. It discounts future cash flows to their present value with the cost of capital being the discount rate. A positive NPV indicates wealth creation for your investors. Now, payback period, this refers to the amount of time it takes to recover the cost of an investment, or how long does it take for an investor to hit break even. This does not consider the time value of money, whereas IRR and NPV does that. Then finally, we'll look at let's look at it from the perspective. Yeah.
I think if we can go to the last slide. So
Yeah.
let me give you some benchmarks on what these numbers are typically. For a lot of transport and logistics project, your IRR, your project IRR typically could be in the range of 12 to 15%, right? Where and that's for a reasonable risk project. Now, what does it imply? Typically, say if your IRR is 15%, your project IRR is 15%. What is the cost of capital typically for a project of that type, right? Say for a warehousing project or a logistics park, your cost of capital at say a 60-40 debt equity ratio would be say about something like 10% or below. So you are it's in one way of understanding this IRR is saying adjusted for time, you are earning 15% return, whereas your cost is 10%. That means your project is profitable, is viable, right? If your project cost is a project IRR is 12%, your cost of capital is 10%. It means what? Compared to the earlier scenario, while you are earning a lower return, your net returns are lower, 12 minus 10, adjusted for time. They are still positive, but lower, right? If your project returns, so which would mean what? So if you factor in risk, for instance, certain years projections are below, actual performance is below projections. In this 12% scenario, you may be in this case where your projects might turn unviable or unprofitable for certain years, right? So it could mean what? It could mean possibly that the level of risks being taken is too high. the cost of capital is not appropriate, your projections may also be wrong there, right? You may have probably underestimated the potential, or you may have overestimated the costs. So when you are getting these numbers, one good check is to look at, say, what my projections are and how realistic they are compared with the benchmark, compared with peers, and then also evaluate the final numbers, okay, before taking a final call on the viability or not. Remember that point we talked about black box, a model being a black box. Often to most people, you will share your model, may not look at your model in great detail. Say, okay, these are inputs, these are calculations. I don't know what these calculations are. I consider it as a black box. The model is giving me this output. You need to be responsible for how these calculations are and what they mean. A number by itself does not mean much in a financial modeling, because a lot of these are estimates to begin with, assumptions to begin with. Try and connect them to reality by doing a comparison on how your inputs are, what your business logics have been considered, and your outputs. Yes.
So now let's look at this from the perspective of the capital providers like equity investors and banks. So the first metric that we'll discuss is EV by EBITDA. Now this ratio compares the EV, which is enterprise value of the project, to its EBITDA. It's a useful benchmark, especially for valuing or comparing infrastructure assets. The measure may be particularly relevant in case of the financial modeling is done for valuation or equity investment purposes. Now, similar to EV by EBITDA, we have PE ratio, which is a price earnings ratio. Now, this is mostly used by listed infrastructure firms. It tells you what the market is willing to pay for every rupee of earnings. How to read these valuation numbers is like any project will normally get valuation similar to its peers. So unless there's a strong reason to justify a premium or discount, mostly all the projects will get a similar valuation. Then comes debt service coverage ratio. Now, DSCR, it is a key metric which is considered by bankers. Now, DSCR measures how comfortably the project can pay off its debt. It's calculated as cash available for debt service divided by the total debt service, which has interest plus principal. Now, lenders typically they look for a minimum DSCR which is above 1.2. Remember that DSCR is affected by the interest cost and debt repayment schedule. A change in these can significantly impact the numbers. There may be other measures used like interest coverage or debt equity ratio.
So a quick question. What is the typical EV EBITDA and PE ratio in the Indian market, in the Indian listed space for transport and logistics sector? Could you provide your guess, or if you know the number, what is the typical EV EBITDA a transport logistics company gets in the Indian market, in the Indian stock market? You could put in your answers in the chat. So transport and logistics is typically valued at a lower rate. I mean, compared to the rest. So your 18x, yeah. So presently, we would have numbers which would be in the range of, say, about 15x, 20x for better companies, 12x, 10x. So 15x could be an average for the transport logistics sector compared to, say, what Nifty gets. Nifty would be getting possibly a 25, 30 EV EBITDA. So it's good to keep these margins, these metrics in mind when you are calculating that, doing your financial modeling, especially for valuation purposes. Yes. Aditya, we can go to the next slide.
Yeah. So again, we'll have another question. And so which metric is most useful for assessing a project's ability to service its debt obligations? So your options are here. You can put your answers. So yeah, the correct answer for this is DSCR. Right. So now that we've discussed the
Aditya, if you
structure,
can go back, if you can go back
yeah.
to the slide, the last slide, the question slide. Yeah. So let's suppose your DSCR is not calculated, right? Can you still assess the debt viability of the project if other numbers are there? Okay. Now let's look at each one of them. NPV. If your NPV of the project is negative, it's very likely to be unsustainable, and especially when you're considering NPV for a similar period as a debt, right? If your debt repayment is in the first 5-7 years, if you have a negative NPV, then it means that your debt would not be serviceable. If your NPV is positive, it means your DSCR is likely to be in the positive range. Payback period. If your payback period is significantly longer than your debt repayment period, right, then it would be a problem. So for instance, if you come up with a project and you're doing a very high level calculation, you say, okay, this payback is not less than 10 years. Okay, it would mean that whatever you do, a 5 years, 7 years debt repayment will not be suitable for such a project. You'll have to look at financing which goes beyond 10 years. Right, repayment which goes beyond 10 years, right? Similarly, your IRR, if your IRR is less than the cost of debt, your project IRR is less than the cost of debt, yours is not going to be good. Whereas, for instance, there might be instances where IRR is good. Say, suppose you have an IRR of 15%, against a cost of capital of 10%, and your DSCR, your minimum DSCR in certain years is say less than 1, right? Now, does that mean the project is not viable? If you look at a single number, it would show that your project is not viable. But the challenge here may not be on the viability of the project as much, but more on how your debt repayment schedule is. Possibly the kind of debt financing terms you have got is not suited for the project, right? So then you go from, say, a regular repayment structure to, say, a ballooning repayment structure, or a longer moratorium period, or other terms like, say, a DSRA, or a debt service reserve account, or some kind of other mechanism to deal with DSCR, a bad DSCR in certain years. So from financial modeling, you take one step ahead, and then you get what is called as the project structuring, your financial structuring. So your financial model helps you do that. Yes, Aditya.
Yeah. So now that we've discussed the structure and key metrics, we will break down the actual step-by-step process of building a financial model. Now, whether you're doing this from scratch or you're reviewing a consultant's model, these are the stages that you need to watch for. So the first one is to understand the project. Now, before you touch Excel, before you start with the financial model, it's important for you to understand the scope of the project model. So you would look at the product, the process, customers, pricing basis, and operational aspects. You would also look at the revenue model. You would look at if it's fixed lease, variable, or volume linked. Also, look at the timeline. What is the construction period, ramp up, and concession life? And you would also take in consideration any regulatory frameworks like PPP terms, tariff controls, or MOUs, and also look at business risk and projects USP and strengths. So you would It's important to spend time here because the better you understand the business model, the more robust your financial model will be. Now, uh, you would start with building the capex and financing module. So, a key point would be that all assumptions should ideally be in a common sheet or otherwise clearly marked out. So, start with creating a project timeline. List all your assets like civil works, plant, equipment, land, contingencies. Input debt versus equity, interest rates, repayment schedules, develop drawdown schedules, and debt and interest schedules. Don't forget depreciation. It could be straight line or WDV method as per your local accounting norms. Then you start with building the revenue model. In this, you would identify and map each revenue stream. So that could be volume into rate, or lease area into occupancy into rate, or tonnage handled into your tariff. So now where the dynamics will be different, in those cases, divide them into segments and also build assumption for base, high, and low cases. It's best to add scenario toggles early on because it saves time later during review. Then you would go on and build your OPEX module. So over here, firstly, you would categorize your cost into fixed costs and variable costs. So fixed costs would include your salaries, admin, security, and variable costs would include maintenance, energy, fuel, handling. Now over here, the important point is to include escalation assumptions. You can take an example, let's say 5% annual inflation, and also use historical benchmarking or vendor quotes wherever they're available. Then finally, you would use your Excel formulas to link your modules into the financial statements, which are profit and loss statements, balance sheet, and cash flow statements. You need to ensure that your model balances, your circular references are handled, and logic flows top down. For large models, you can use flowcharts to track your dependencies. Then you would calculate your returns and as required. So you can calculate your project IRR to look at the total project performance. You can calculate equity IRR for the investor's view, payback period, DSCR, NPV. Now, these returns and other financial metrics, they should be aligned with your decision parameters of the business. These numbers are what you show to the lenders, investors, and government agencies. So also run them across the three scenarios, which are base, optimistic, and pessimistic.
An important point to understand here when you're building a model is that it will be an iterative process, right? While it has to be structured, it will be an iterative process, which means you'll not get it right the first time. So allow for that mentally and physically in terms of that, how you're preparing mentally and the time you allot for it. So a good way is to, when you're starting with step one, which is understanding the model, try and visualize how it would go going forward. So it helps you there, and then the rest of the process becomes fast. Sometimes I mean typically a model may take a week, 10 days, maybe sometimes even more when multiple people are involved and the process is complex. There have been cases when, I personally, for instance, for me, I have worked on models which have taken, say, about maybe 2 to 3 months to develop because there were many stakeholders, many points of views, and the project was kind of complicated. It was an integrated project. So iterative process is one important thing to keep in mind. Inputs need to come from different sources because your inputs are important. Don't treat financial modeling as a desktop job that you sit, you have things in place, and then you prepare a model. Understanding a business model takes time. Sometimes the numbers, the reports you get are not sufficient. So it's a good idea to talk to people and say, okay, fine, why are these numbers like that? Are there different options? Is this particular to this specific case or not? So you think about that. And a third point to understand and keep in mind is that your model needs to be aligned with the decision-making process, which means what? One, the language you speak in the model needs to be aligned with what how your decisions are made within your organizations or your customer organization, your client organization. Banks have a certain way of talking. Public sector banks have a certain way of talking. They have a certain language. Private sector banks may have a certain language. Teams which, within banks itself, banks which have greater experience in project finance may talk in a certain language compared to others. Some may like details, some may like summarized, some may be very particular on certain numbers, some may look at a set of numbers. So understanding the requirement is important, speaking that language is important, and presenting in that language and requirement is important. So there might be situations where you prepare one model, but the facade, the summary, the output of your model may look different when you're presenting to different set of stakeholders. So be prepared for that. Yes, Aditya. We can go to the
Yeah.
common mistakes thing. I think we are a little
All
stretched
right.
on time.
Okay. All right. We'll do that. Right. So let's talk about what can go wrong here and how can we avoid it. So the first mistake that can be made is no clarity on project structure. So it is important to always define project boundaries clearly, like your ownership model, SPV structures, and PPP terms. Then the next mistake would be unrealistic revenue or cost forecast. So overestimation can inflate your revenues and it could lead to wrong investment decisions and funding issues. Now, the third mistake would be incomplete cost estimation. So OPEX, as mentioned earlier, it should include escalation, preventive maintenance, and contingencies. Because if you don't include them, it would lead to underestimated expenses, and that would lead to misleading profits. Then, no sensitivity testing. So if you assume that everything will go right, that is very dangerous. So it is very important to always test your downside scenarios. And finally, a frequent pitfall in financial modeling is the inclusion of non-transparent assumptions. So this occurs when key inputs or drivers within a model are hard-coded, buried deep within formulas, or lack clear dedicated input cells with explanations. So because of this, users cannot easily identify, understand, or modify these assumptions, making it difficult to perform sensitivity analysis and audit the model.
Yeah. An important point here is when you're talking about sensitivity analysis, often, when we think of it, we think of it on the downside terms. Okay, what happens if what worse can happen if something goes wrong? Yeah. It
Mm.
When you're doing your financial modeling, prepare your model for calculation on the upside as well. Projects are, remember, you're estimating a certain version of reality. It may come true on the downside as well as on the upside. Prepare for that. What happens if then, right? So your sensitivity analysis should not be just one-sided, because businesses can have upsides as well, and you need to be prepared for it. What happens is, suppose if your revenue projection is faster than normal, okay, then what happens? See, there is a very interesting case, and in project finance also people have learned about it. In toll roads, there are certain toll roads. A very classic case is the Delhi Gurgaon tollway. It was projected for a certain level of traffic. Day one opening traffic was like 2x of projections. Now what do you do then? In the concession agreement, they did not have an upside sharing of costs, or so profit. So one party made all the money, the other party did not get the money. What would typically happen then? Then there would be a dispute arising, and your project gets into a problem because the stakeholders are not getting equitable returns. So think of those scenarios as well. I know, I mean, some of you are maybe too young to look at those projects, or be getting into details as much, but when you start thinking about these options, in a shorter time frame than others, you have a much mature understanding of how projects can go.
Right.
Yeah.
Yeah. So when building and presenting your model, here are some of the rules you should follow. So firstly is the 80-20 rule. So focus on 20% of the inputs that impact 80% of your outcomes. So don't overcomplicate things unless the use case demands it. So for example, you can have a case where a client has around 45 to 50 line items in the OpEx, but only 5 to 6 truly move the needle. So focus on those, prioritize them, and then move ahead. Then
Yeah.
some
Another,
variable.
Aditya, just one point here.
Yeah, sure.
So when you're looking at simple and complex, 80-20 is a good rule to follow. Another rule is when you're using the Excel formulas, keep your Excel formulas simple. If you are having, say, to do a complex scenario, break it up into different segments. So it's easier to understand, like don't have a nested formula which will, like have 10 brackets. It's difficult to read, and, even when you're articulating that, it's difficult to do that. So break it up and say, okay, from going from A to B will take a route of A, C, D, and then B. That's fine. You may have more rows, but if you go directly from A to D in a complex manner, it becomes difficult to understand. And when you're reviewing it later, you don't really know, where the error has occurred. More complex, more chances of error. Yes, please.
Right. So, yeah, as I was saying, so some variables like lease rates or escalations, they need to remain editable because hard-coded values they make the model rigid and dangerous. So, and after that, you also need to include your built-in checks like balance sheet checks that would ensure that the asset and liabilities match. Then cash flow validations to make sure that there's no negative cash balances, and if they occur, provisions will be needed to be made. Then peer reviews can always catch logic gaps that you miss. So reviewing and auditing is very important. Walk through your model line by line with the colleague. Keep a version control log with change comments. And finally, your even a perfect model can fail if a stakeholder cannot understand it or read it. So use a dashboard with summary outputs, waterfall charts for cost breakdowns, and graphs across scenarios.
Yeah.
Make
An
Yeah.
important point to understand and keep in mind is sometimes is, the version of Excel. A lot of times, you may be working on a certain version of Excel. Somebody else may have a different older version of Excel. Some formulas of Excel don't work on the older versions. Macros, avoid macros is what I would say, because sometimes people would not switch it on or whatever, and they may not understand from where things are coming on. Sometimes you have to do, when things get complex, it's fine, but keep that in view. So, maybe you can have an instruction set, etc. But compatibility is an important point of view. If somebody is working on, say, a Windows, or somebody else is working on a Mac platform, uh, things may not work in Excel. So keep those things in mind. Yes, please.
Yeah. So now one of the most powerful features of any financial model is the ability for it to test what if. So now we'll talk about sensitivity and scenario analysis. So the first step would be to identify key variables. Now, in this, you would start with 3 to 5 drivers that impact your outcomes most. So, infrastructure, these are typically traffic growth, construction costs, interest rates, inflations, and tariff escalation caps. Now, once you have these drivers, then you would run them through scenario tests. You would build your base case, best case, and worst case. So let's say you're making a financial model for a port terminal. You can take your base case to have, let's say, around 6% cargo growth, best case to have 9% cargo growth, and worst would be 3% cargo growth. And then you would toggle between these to see an impact that it has on the IRR, DSCR, and NPV. Now, then after that, you would evaluate the decision impact. Now, this is where your real insights lie. So once you toggle between these scenarios, you would see the impact that it has. And let's say, for example, if a 2% fall in lease occupancy, it drops your DSCR from a 1.4 to 0.9. you would know that this project would need more tenant lock-ins and revenue guarantees. So because of all of these reasons, sensitivity testing, it builds confidence with lenders, equity sponsors, and regulators. Now, a pro tip here would be to add a sensitivity dashboard with sliders or data tables. This would make your model more dynamic and make you look more polished.
Yeah. See, when you're doing a scenario analysis, another point to understand is there could be a scenario of on a different strategic level itself, right? Lease short term, lease long term. Your classic build or buy kind of scenarios where your business model itself is different. It's something you may be asked to do. You build a financial model basis a certain business model, but there could be situations where a financial model also has to address multiple business models. How, say for instance, how land is brought in, how tenants, for instance, how how you deal with, say, an anchor tenant and others, and so on and so forth. Be prepared for that. And so when you're looking at scenario analysis, you can build these cases, right? So you have your set of assumptions. Scenario analysis involves basically a set of assumptions. You build those in, and that way, and then you pick up from those scenarios. So your single financial model can have your multiple branches, so to speak. So think of on those lines as well. Things get complicated because of that, but it gives you a certain very high level of flexibility. A difference between sensitivity analysis and scenario analysis: in a sensitivity analysis, you are basically changing one variable to see what the impact, positive or negative. But in scenario analysis, you are dealing with a set of assumptions. So you'll have 5, 10, 15, 3, 4, whatever set of assumptions, which will be specific, unique to a certain scenario and different for another scenario.
Right. So, yeah, I think we can skip this. Yeah. So now let's briefly touch on how infrastructure projects are typically financed, especially in emerging markets like India. So, firstly, we'll talk about public-private partnerships. So this is widely used for toll roads, metro rail, and ports. So here the government, it shares risk with private investors who bring in capital and efficiency. Over here, you can use models to evaluate viability gap funding, concession life, and equity IRR for investors. The next one would be project finance. So over here, banks, they lend not to the company but to the project. And over here, cash flows from the project are the only source of their repayment. This is common in roads, airports, and logistics park. Over here, your DSCR becomes the most critical number. Then we talk about mezzanine and hybrid instruments. So these are hybrids like convertible bonds, preference shares, or subordinated debt. So these are useful when you don't want to dilute your equity, but you can't raise more senior debt. Then we have equity financing. So this is typically seen in your early stage logistics startups, private equity funded warehousing platforms, or listed infra companies. Models here, they focus on return on equity, dilution, and value creation over multiple rounds. Next, we're going to talk about the tools for financial modeling. So now to build a robust and reliable financial model, we rely on two key enablers, which are the spreadsheets and data sources. Now let's break them down. So spreadsheets, these are the heart of financial modeling. They allow full flexibility for formulas, assumptions, and linked calculations. So tools like Excel and Google Sheets, they support everything from simple projections to complex macros, scenario switches, and dashboards. Now, why spreadsheet is because they enable customization. Every infrastructure project is different, so that is a very key point here. And then there is also, you can also, there is a dynamic linking. So you can see one change in an assumption could reflect across the model. And stakeholders can also trace the logic easily. Then comes your data sources. So your model is only good as the data you feed into it. So that's why strong data inputs like traffic studies, industry benchmarks, capex trends, land rates, construction timelines, these are all essential for accuracy. Now, where does this data come from? You could look at government reports from NHAI, DPIIT. You can do your industry research. You can look at past project feasibility reports, and you can also look at market surveys or vendor quotations. Finally, let's wrap this all up with a quick recap. So, firstly, you would start by understanding the fundamentals. So, good models, they start with good assumptions. So, never skip your research. Ground every number in either data or logic. Focus on mastering key inputs, model structure, and interpreting financial metrics which are relevant to your sector. Then I would say practice real projects. So start small, take a warehousing case or toll road and build a simple model. Gradually add complexities into it like scenario switches, dead schedules, and dashboards. Then commit to continuous learning because financial modeling is evolving. There are tools like Power BI and specialized infra tools like InfraDeals or Trading that are changing the game. So you have to stay updated and also follow industry news, study real project term sheets, and review models that are used by agencies like NHAI or NIF. Finally, your financial model, it is an indispensable skill in transport, logistics, and infrastructure sector, enabling professionals to support strategic and operational decisions effectively. Your ability to build or even review a financial model, it makes you valuable in consulting, banking, policy, and industry. So don't worry if it feels complex. Like anything else, this is just a skill that compounds over time. Thank you all for your attention. I hope this webinar gave you both structure and clarity. I'll now open the floor to any questions. Thank you.
Any questions?
Yeah, you can put your questions in the chat box.
We don't have questions now.
Right.
So we could close the session.
Right. Okay. Thank you all once again for joining. And yeah, thank you.
Thank you.